What's going on, everyone? Lalit here. As the title alludes, today we'll be looking into how to buy Bitcoin, not just in general, but for cheap, aka cheaper than its current trading price at any given time. From Bitcoin's existence from back in the day and fast forward to now, a lot of folks, including myself, wish we had more so we could reap those gains. And now with Bitcoin hitting 60K plus in terms of all-time highs and still trading in the tens of thousands of dollars just for one coin, a lot of folks from back in the day not only wishing they had more, but today they're looking at Bitcoin from 60K and can it go to 100K, and eventually it can go to the moon, aka $1 million, and from there it can go even beyond to the end of the universe. So with that, we'll be looking over a couple scenarios on exactly how to buy Bitcoin for cheap, and a couple disclosures: not a financial advisor. And the second thing is, we're not going to be looking into exactly which apps or exchanges have the least fees or the least price in that moment in terms of current trading price for Bitcoin. And so if you like that video, do comment down below. But with that, we'll get straight into it. First off, before we get too deep into it, I wanted to cover what I'm using for the definition of cheap. And so straightforward, cheap equals lesser than what the current value of Bitcoin is trading at any given moment. Here's some thoughts for you to consider as we walk through the video. How would you feel if you didn't need to time the exact bottom on a dip to buy Bitcoin in order to buy it there, such that you needed to ride it all the way back to top to see those gains? How would you feel both mentally and financially if you didn't need to constantly average down your average cost of Bitcoin every single day there's a red day? And above all, what if I said there's still a way for you to make money with your Bitcoin even if Bitcoin fell in price, even if it fell below your average cost? The positive side to answer these questions is exactly what we're going to accomplish today, and how we're going to do it is by going over options in Bitcoin. We'll look through a couple examples, couple scenarios, learn the ins and outs of what are we looking at from a pro's perspective, a con's perspective, etc. And so with that, you know how it is. See you on the other side. Here I am at the options trading platform, and this one specifically known as LedgerX. There's a full video on the channel if you're interested to see a tutorial / demo and hands-on experience of exactly how it works. So looking at it over here, we got Bitcoin over here trading at 37,665 at the time of this recording. We'll be looking at a couple examples both on the call side as well as the put side to understand exactly how much are we really potentially decreasing our average cost by, aka how are we getting that Bitcoin for cheap. So here we have the options chain in front of us, and for June 4th, 2021, that's this current week's expiry date. So as we scroll down, there's June 11th and then June 25th, and after this point it goes basically in 3-month intervals. Now what we're going to be looking at is basically an example of this $40,000 strike price. I'll put the math up on screen so we have an easy way to walk through these numbers. So there's an assumption that we'll take, and with Bitcoin trading around $38,000, just for math simplicity, we'll assume that our average cost of Bitcoin is $38,000. First, we'll be looking at calls, and so the fact that your average cost is $38,000 basically is assuming that we already have the Bitcoin with us, so that would act as the collateral for the underlying call contract. So coming back to this $40,000 strike, essentially if you bought Bitcoin at $38,000, the premium over here that it displays over here is you got a bid and ask. So you got a bid of $18.33 and you got an ask of $22.30. And so the assumption is if we put, for example, one Bitcoin worth of underlying asset, if you're getting $1,833 of premium on the assumption that our Bitcoin's average cost is $38,000, then essentially what we're looking at is a 4.58% return on collateral. With the current average cost being $38,000 and the premium received being $1,833, essentially our new average cost becomes $36,167. Let's look at another example. So you got over here 3 months later, September 24th in terms of expiry. So 40K, same strike price. What we're looking at over here in terms of premium collection is $6,050. In this situation, our average cost is still that same $38,000, but because of the premium we receive over here of $6,050, we're looking at a return of almost 16%. This 16% received decreases our average cost from $38,000 all the way down to $31,950. This says that indeed, yes, we did decrease our average cost, but there's some pros and cons that come with selling calls. From a pro's perspective, we definitely indeed decreased our average cost straight off the bat. And the reason is because that premium that we receive, although the duration for the contract may be far out into the future or coming up, either which way we get that cash today. Another pro of this, aka getting into our covered call contract, is essentially that as Bitcoin price goes down, aka if it goes from this 37,000 change even further down, the value of that contract also goes down. With the value going down, you can essentially close your contract, and so since we received the money today when we open this contract, naturally when we buy to close it in the future, if it's lesser than what we paid today, then we'd get to keep that difference. The value in this is that even if the underlying collateral, aka that same Bitcoin that we bought at $38,000, let's say Bitcoin's price goes down to 35K, to 30K, to 25K, etc. As the price of Bitcoin goes down, the option price tends to go down as well. And so today, if we receive that money today, this premium, then fast forward some time, even if the underlying asset goes down in price, we still get to keep that premium. The point of this is to say is that we have downside risk protection. On the flip side, if we look at the cons of selling our covered call position, then essentially it's basically potentially leaving money on the table. With the $40,000 strike price, whether it's June or whether it's September or any other different date, let's just say Bitcoin has a rally and it goes past the all-time highs of 60K plus and it goes boom, 70K, 80K, 100K in a short span before, let's say, this June 25th date or the date in September. And so basically, if you're agreeing to sell your coin at 40K, but let's say it rockets to 80K, just for example, you're leaving huge amount of money on the table is basically what it looks like. At the same time, it would be wise to not get into these type of contracts if it doesn't suit exactly what you're looking for. With that, let's look at a couple put examples. So looking at the same strike for $40,000, but on the right side here being puts, let's say there's $4,000 in terms of premium. So I'm rounding off here, but basically this $4,000 is what we'd receive in premium today. But the difference between calls and puts is that with calls, we already had the underlying asset, aka Bitcoin, to sell the covered calls. But when we're selling puts, we're basically saying, hey, we have cash in the account and we're willing to buy Bitcoin at a certain price in the future. So with that, if our strike price is $40,000 and we're getting $4,000 in premium, our average cost essentially is $36,000. Now, the average cost is $36,000, which let's just say we were assuming we were okay with paying that $38,000 figure, then basically we're still getting in at a cheaper price than what we're anticipating or at the current market price. But this may not happen because Bitcoin essentially needs to be below $40,000 by that certain date, in this case, June 25th. And so let's just say, for example, that Bitcoin closes at $41,000, then you wouldn't get any Bitcoin, but the advantage being you would keep all of the premium, aka that $4,000. Keeping that $4,000 is essentially a 10% return, and that comes from the fact that essentially $40,000 was put aside as collateral in cash for if Bitcoin were to fall below $40,000, you would basically exchange that cash for Bitcoin. Another way to look at it is that any amount of collateral that you're putting up, in this case we're using $40,000, but you can replace it with your figures because the percentage of 4,000 divided by 40,000 is essentially 10%. At the time of this recording, within a month, you're looking at 10% cash on cash return. At the same time, with Bitcoin trading at 37.5 around that range, we're basically willing to pay 40K. And so if you do the math, you're essentially saying that, hey, I'm going to spend 40K, but I'm receiving 4K, and so your average cost would be that $36,000 figure. This goes to say that essentially once Bitcoin goes even below $36,000, if it does, that's when you're basically losing money essentially. With calls, you have unlimited loss just because Bitcoin can go to infinity, and at the same time with puts, your risk is defined, but at the same time, if we're willing to buy, let's say accounting for all premium received, Bitcoin at that average cost of $36,000, but let's just say there's a flash crash and it goes to 25K or 20K by expiry, then you can also be holding Bitcoin at a supremely higher above average cost than you had once intended. Looking at this example for puts for September 24th at 40K strike as well, the premium you'd receive is $8,600. And so when you do the math of 40K minus 8,600, you're looking at basically $31,400 in terms of your average cost. This $8,600 that you're getting in premium is essentially 21.5% cash on cash return upfront when you open that contract. And although it's a little more than 3 months away, it's pretty much like 7% a month. From a puts versus calls perspective, with calls, we actually have our underlying asset with covered calls, aka our Bitcoin. On the flip side, when we're selling puts, we have cash as collateral, but we don't have the actual asset. This is to say that essentially if Bitcoin has a massive rally and we sold some puts to get Bitcoin at a certain price, if it never goes below that price, we won't actually get that Bitcoin. On the other hand, let's say Bitcoin has a massive rally before that expiry date. Now, if it doesn't go below the strike, we won't get the actual assignment of our Bitcoin. But on the other hand, because let's say it goes to 50K, 60K, 100K, etc., basically that same contract value of the option contract we sold, that also would tend towards zero. And so the higher the price goes, lesser is the value of the contract, aka we get to pocket the difference if we buy the close or keep the full premium by expiry if it basically closes above that strike price. Comment down below if you want to see a Bitcoin options for beginner type video. But with that, you know how it is. Thanks for coming to the end. Peace.